So first of all, it's important to understand what bonds are and how they differ from equities, also known as stocks. When you invest in a stock, you are buying a piece of equity in a real business, making you a part owner of the company. If the business does well and the revenues and profits grow, the business becomes more valuable and the price of the shares goes up too. However, with bonds, you are not buying equity in a company or entity. Instead, you are simply loaning them money. Bonds are issued by companies or governments, and they pay a set rate of interest. Now, similar to stocks, the market value or price of an individual bond will fluctuate based on buyer demand as well as other factors like the Federal Reserve interest rates. And the interest rate that a bond pays is going to be based on the borrower's creditworthiness or risk associated with loaning them money. Higher quality bonds from reputable borrowers will actually pay a lower rate of interest, while lower quality bonds from less attractive borrowers are going to pay a higher rate of interest. Now, the bond maturity or the amount of time until repayment is due also has a lot of influence on the interest rate that a bond pays. Bonds with shorter maturities normally offer a lower interest rate as the risk is lower than a longer term maturity. Simply put, if somebody owes you money, there's normally less risk involved if they've agreed to pay you back sooner rather than later. Now, as a lower risk investment, overall returns from bonds are lower than the historical returns of the stock market. But when the stock market inevitably enters a bear market, the downside associated with bonds is not as severe as with stocks. Simply put, your portfolio would drop a lot less if you had a 50-50 mix of stocks and investment-grade bonds, which we'll talk about that shortly, compared to owning 100% allocation into stocks. Most of what we've talked about so far applies to corporate bonds, but there's other types of bonds out there that you need to be familiar with. While companies do issue bonds as a means of raising capital, governments all over the world are actually the biggest issuers of bonds. Government bonds are generally looked at as more stable and less risky when compared to corporate bonds, and that's because you're betting on the stability of an entire government. In addition, governments have the option of increasing their taxes if their debt repayment costs get out of control. At the very top of the government bond pyramid in terms of the highest quality investment and the lowest risk, you have U.S. Treasuries, which are considered to be the safest bond investment out there that exist. The only way the U.S. government is going to default on their obligation to repay you is if the United States itself went bust, which obviously is not very likely to happen. But since these are viewed as the safest bond investment out there, the returns are going to be among the lowest out there. So far, we've covered corporate bonds as well as government bonds, but there's one more important type to talk about, and that is municipal bonds. These are bonds that are being issued at a state level or by local municipalities such as a small town, village, or even city. Municipal bonds are right in between U.S. Treasuries and corporate bonds in terms of the risk factor. While local governments can increase taxes too, they aren't as sure of a bet as the strength of the United States government. However, these municipal bonds have a unique tax treatment, whereas interest earned is free from federal taxes and in most cases state taxes as well. But this overall benefit does lead to bond yields for municipal bonds being relatively low.